Hello friends, let us start with case study of Mr. Roger. Every case study starts with some reference date. Here the reference date is 1st April 2017. Roger, aged 29 years, is working with a multinational company since December 2010. He has approached you, a CFP practitioner, for preparing his financial plan. He is staying in his own house at Ahmedabad. His wife, Angela, aged 31 years, is a fashion designer. She has set up a boutique on rent and earned a net profit of rupees 5.5 lakhs in the previous financial year. They have a son, Mark, of age 4 years, and a year-old daughter, Stephanie. Roger is also supporting his parents to the extent of rupees 20,000 per month. They stay at their ancestral house at Surat. The family's monthly household expenses are rupees 40,000 per month, excluding insurance premium and EMIs. Roger normally gets 10% increase in his gross salary year on year in the beginning of every financial year, apart from bonus. The bonus for the previous financial year at rupees 3.3 lakhs shall be credited to his account at the end of this month. He has taken a family floater health policy for rupees 15 lakhs premium paid in the previous year is rupees 16,268. This is case study of Mr. Rogers, and also you can find his monthly salary here, and couples current assets and liabilities are given, and if you go down you will find goals of Rogers and other assumptions regarding pre-tax return in various asset classes. Friends, please read the case study carefully. Once you complete reading the case study, after reading the case study, the next step will be to draw the timeline. So for drawing the timeline, first see the Rogers age. Rogers age 29 years. So Roger, draw the case study. He draw the timeline. He is 29 years old, and go back to the case study and see the goal number 3. Here it is given that retirement corpus at Rogers age of 58. That means he is going to retire at the age of 58. 58 will be the retirement age. Then after 58, he is going to survive up to, what is the life expectancy? Let's check life parameters. Rogers expected life is 75 years. That means this is 75 years. Okay. In the same timeline, you can give the details of Angela as well. So Angela, what is the age of Angela? Angela is 31 years. So Angela is 31 years. When Rogers is 58, Angela will be 60 because she is 2 years elder to Rogers. When Roger is 75 years, Angela will be 77. Let us see the life expectancy of Angela. Go back to the case study, check the life parameters. So Angela's expected life will be 8 years. That means she is going to live 3 years more than Rogers. Okay, so this is your case study. Before starting any problem, please draw the case timeline and start working. Let us go to the first question. So the first question here is, before beginning work on Roger's financial plan, you have drafted a document outlining the scope of engagement and sought Roger to mutually define and determine the activities that may be necessary to pursue. Rogers asked you about relevance of such document in the context of financial planning profession. You explain about the letter of engagement as option A. Professional requirement under Code of Ethics of FBSB India. Professional requirement under Practice Guidelines of FBSB India. Necessary legal requirement as per Contact Act 1872. And D. Document for his personal record. So friends, letter of engagement is the professional requirement under practice guidelines of FBSB India. So option B is the right answer here. So let us move to the second question. You have finished analysis of Roger's financial situation and risk profile. Which of the following is the next appropriate step in the financial planning? So options are Specify financial goals which can be achieved within Roger's financial situation based on the information collected. Fix the scope of engagement based on the available information already collected. Consider such assumptions of investment returns, inflation, tax rates, etc., as to maximize the chance of achieving Roger's goal. Identify other issues that may potentially impact Roger's ability to achieve financial goals. These are the four options. You have completed with analyzing Roger's financial situation and identify the other issues that may impact Roger's ability to achieve his financial goals is the right answer. So option D is the right answer here. Okay, let us move to the third question. Let us move to the third question. Roger wants to estimate the amount of finance needed to buy the proposed new house after 5 years. This could be arrived at by utilizing the net amount from the sales proceed of his existing house after 5 years. The outgoings from such proceeds would be the outstanding loan amount and a sum of rupees 10 lakhs towards meeting capital gains, tax liability on existing house and the statutory charges, etc. You expect the average repo rate of 6.5% to be maintained by RBI over the next 5 years. The quantum of loan required could be. Here, they are talking about buying a new house after 5 years. It is said that this could be arrived at by utilizing the net amount from the sales proceeds of existing house after 5 years. By this statement, we can understand they sell off their existing house, that is, the sales proceeds of existing house will be utilized as a down payment and also clear the outstanding loan amount and keep aside rupees 10 lakhs towards meeting other statutory charges. So here first step is let us find the sales proceeds of existing house. For that we have to go back to the case study. So in the case study in asset sections, in the asset section you will find the market value of existing house, that is 75 lakhs. So now we have to find the future value of this house after 5 years because they are going to sell this house after 5 years. So first step is find the future value of existing house. Okay, so here rate of appreciation of real estate is given as 6.5%. Then n per, that is time by which the house will be sold is after 5 years. Then PMT, that is payment, there are no payments here, therefore PMT is 0, and present value PV is 75 lakhs. Present value of the house is 75 lakhs. So let us find the future value. So here formula will be FV rate will be 6.5%, n per is 5 years, PMT will be 0, and present value will be minus 75 lakhs. Okay, and type may be 1 or 0. So if we calculate this, we will find the present value of existing house after 5 years, that will be 1 crore 2,75,650 rupees. So here rupees 1 crore 2,75,649 is my sales proceeds, and by this loan proceeds now we can calculate the outstanding loan liabilities. For loan liability we need to check the loan details. Going back to the case study, they are saying home loan of rupees 17 lakh 85,000. So footnote 8, home loan of rupees 25 lakhs for a 15-year term taken in April 2011 at rate of interest fixed for first 3 years at 10% per annum and floating thereafter at 1.5 above RBI repo rate. So RBI repo rate is 6.5%, then that means around 8% will be the rate of interest for the next term. So first, for the first 3 years, rate of interest will be 10% per annum. So let us calculate the outstanding loan for the first 3 years. Yes. So here we use the formula COMPRIN to find out the principal paid. That is COMPRIN. So rate is 10% divided by 12. NPER is 15 years into 12. PV, we should not take it as minus. The total loan amount will be 24 lakhs. Start period will be 1 and end period will be 3 years. We are finding it for 3 years and type will be 0. So let us close the bracket. So this is the principal paid during the first 3 years. So therefore outstanding loan after 3 years will be 24 lakhs minus this value. Okay, that is 21 lakhs 58,061 rupees will be the outstanding loan after 3 years. Now, after 3 years, the loan amount is started from 2011. From 11, 12, 13, 14, 3 years. So from 2014, the present date is 2017. That means 15, 16, 17, 3 years, and after that again 5 years. So now we need to calculate the outstanding loan for next 8 years. So let us calculate outstanding loan amount in the next 8 years. First find out the principal paid, same formula, COMPRINS. So here rate will be, they have told 1.5% on RBI repo rate. RBI repo rate is given as 6.5% plus 1.5% will be 8% divided by 12. NPER is already 3 years we have calculated. So from 15 years, if we subtract 3 years, means 12 years into 12, and PV will be this amount, 21 lakhs 58,000. Start period will be 1, end period will be 8 years into 12, and type will be 0 always for home loans. So this is the principal paid in next 8 years. Therefore outstanding loan amount will be this minus this. So that is 9,56,869 will be the outstanding loan on 1st April 2022. So now the down payment for the new house will be sales proceeds minus outstanding loan minus 10 lakhs. So therefore down payment is equal to sales proceeds, that is 1 lakh 1 crore 2 lakhs minus outstanding loan, that is 9,56,000 minus 10 lakhs. Okay, that will be 83 lakhs 18,780. From this down payment, we will have to subtract the future value of new house. So let us find the future value of new house. But what is the present value of new house? It is not given in the question. Let's go back to the case study. Here, goal number 4. A bigger house valued at rupees 1 crore today, 5 years from now by disposing of the current house and foreclosing the loan. That means the present value of new house is 1 crore rupees. So now let us find the future value of new house. So rate is same 6.5%. Yen per is 5 years. PMT no payments, it is 0. Present value of new house is 1 crore. So let us find the future value. Future value will be formula rate 6.5%, Yen per is 5 years, PMT is 0 and PV is minus 1 crore. So type is 1 and this will come to 1 crore 37 lakhs 866 rupees. Now this will be the future value of a new house which is going to buy after 5 years. Now loan amount will be, so here we will calculate the loan amount. Loan amount is equal to, loan amount will be cost of new house minus down payment. Down payment. Okay. So cost of, this will be cost of new house is 1 crore 37 lakhs minus down payment. What is the down payment? Down payment is 83 lakhs. So this will come around 53 lakhs 82,086. So let us make it bold. So the loan amount required is 53 lakhs. That means almost 54 lakhs. So let us go back to question and check the answer. Question number 3 and yeah, option C, rupees 54 lakhs will be the answer. Option C. C will be the answer. Okay, with this, we completed question number 3. Thank you. Let's go to the fourth question. You give a quick look at the assets and liabilities of the couple, and before drawing a comprehensive picture of adequate insurance protection and a strategy to achieve the same, you suggest to take cover on an immediate basis, which is option A. They must take mortgage redemption insurance or an equivalent term insurance to cover outstanding loans, or an accident insurance or critical illness insurance or unit linked policies for their financial goals. As he has various loans, just going back to the case study on the liability section, in the liability sections, you will find he already has home loan and car loan, and also he has himself, life insurance on himself and child. Hence, it becomes important for him to take mortgage redemption insurance or an equivalent term insurance cover for outstanding loans. Therefore, option A is the right answer.